Hello, in this lecture we will take a look at Chapter 10, Accounting Information Systems and Internal Control. So we'll start off with Ethics, Sarbanes-Oxley Act 2002, Corporate Governance. So this is an act that of course happened in 2002 as a reaction to some things that happened in the environment, including Enron, the need for a code of ethics. So part of this is implementing basically a code of ethics, which includes the implementation of internal controls within corporations generally applicable to larger publicly traded corporations. So we have ethical behavior prompted by a code of ethics can be considered a form of internal control. So employees with different cultural backgrounds are likely to have different values. And it's often considered that we have a bunch of core set of values. Many cultures have a lot of core sets of values. We have issues in terms of which values do we put on top, right? So it's not that a lot of times that we value the same types of things. It's which ones do we value more than others. So many professional associations have developed codes of ethics to assist professionals in selecting among decisions that are not clearly right or wrong. So a lot of times when we think about these ideas that are not right or wrong, the question is they're between two different codes of ethics, and the decision may violate one code of ethics in order to uphold another. And the systems that we'll talk about here are in order to basically align these systems within a profession. So if we're talking about SOX, the Sarbanes-Oxley requires public companies registered with the SEC, Securities and Exchange Commission, publicly traded companies for the most part, and their auditors, so those are going to be independent auditors, which are like CPA firms oftentimes, to annually assess and report on the design, effectiveness of internal controls over the financial reporting. So a large part of the audit now deals with basically the internal controls and reporting on the internal controls. So establish the Public Company Accounting Oversight Board, so the PCAOB, to provide independent oversight of public accounting firms. So they are going to look over the public accounting firms, and of course the public accounting firms, being often CPA firms, are the ones who are auditing the companies that are supposed to be the independent third-party auditor of the companies. The PCAOB auditing standard number 5 encourages auditors to use a risk-based top-down approach to identify the key controls. So we're going to basically use a top-down approach to identify what are the key or most important aspects in order to generate basically financial statements that are free of material misstatement. Corporate governance, a set of processes and policies in managing an organization with sound ethics to safeguard the interest of its stockholders. So the idea of a corporation is generally to provide the company to do well for the owners, who in this case are the stockholders. Stockholders being a bit removed from the day-to-day processes of the company. Therefore, in order for the business transactions to happen, we need trust within an organization so that the investors will invest, stockholders will invest, and the ethics will help provide that trust so that business transactions can take place. So it promotes accountability, fairness, and transparency. So this is the same type of things we see in all different types of professions in dealing with trust. We want accountability for activities, we want things to be fair, and we want to be transparent in order for organization relationships with its stockholders. And if that's the case, if stockholders feel that way, then they're willing to do business, they're willing to invest, and that's the key. So overview of control concepts. Internal controls involve the process that an organization implements to safeguard assets, provide accurate and reliable information, promote operational efficiency, enforce prescribed managerial policy, and comply with applicable laws and regulations. According to SOX, Sarbanes-Oxley, the establishment and maintenance of internal controls is a management responsibility. So management is responsible for the implementation and maintenance of internal controls. 3 main functions of internal controls. We want to prevent controls. So preventative controls deter problems before they arise. Things like authorization. So those are things that you may think of kind of like bureaucracy. As the company gets larger, we have more things such as authorizations before we can get the process through. But of course we need those authorizations in order to have stronger internal controls as companies get larger. Detective controls find problems when they arise, such as bank reconciliations or monthly trial balances. So what happens there is the bank reconciliation is usually for us seeing if we made an error by comparing our books to the books of the bank, and that happens after the fact. So after an error has happened, we reconcile and hopefully catch it. Correct controls fix problems that have been identified. Backup files, recover corrupted file data. So if there's an issue and we need to go back in time and recoup data from the past, we need to have those backup files. Computerized environments. General controls pertain to enterprise-wide issues such as controls over accessing the network, who has access to what within the network and database programs, developing and maintaining applications, and documenting changes and programs. So those are general controls. Application controls are specific to a subsystem or an application to ensure the validity, completeness, and accuracy of the transaction. So those are more localized activities. Commonly used internal control framework, the SEC, Securities and Exchange Commission, requires management to evaluate internal controls based on a recognition of control framework. So once again, the SEC is going to require the analysis of the internal controls. COSA, Internal Control Framework, a COSO committee of sponsoring organizations of the Treadway Commission. We have the AAA, the AICPA, the FEI, the IIA, and the IMA. These and the COSO Internal Control Framework is one of the most widely accepted authority on internal control, providing a baseline for evaluating, reporting, and implementing the control. So that'll give us somewhat of some standard baseline rules for us to evaluate and implement and look through the internal control systems. And notice that a lot of these organizations we're taking a look at, of course, are professional organizations, and the idea of a profession most of the time is to have some code of ethics in many cases in order to build that trust within the profession. So COSO Internal Control Framework, we have number 1, internal control is a process consisting of ongoing tasks and activities. It means it is a means to an end, not an end of itself. So an internal control is an ever-changing process is what that means. We're not just going to implement it and leave it alone. It's always an ongoing thing that we can improve on and analyze. Internal control is affected by people. It is not merely about policy, manual, systems, and forms. Rather, it is about people at every level of the firm that impact internal control. So although internal control does have systems and manuals and whatnot, it's also about the whole system in general, which involves people and how people are relating to those systems, and also about the culture of the organization as a whole from the top, usually from the top down, because that's usually where culture is from. Number 3, internal control can provide reasonable assurance, not absolute assurance, to an entity's management and board. So internal controls is geared to provide some assurance about the integrity of the information being provided. And of course, it can never give absolute assurance. We're never going to say that things are absolute assurance, but we're going to have as many safeguards as we can to provide more assurance. Internal control is geared toward the achievement of objectives in one or more separate but overlapping areas, and internal control is adaptable to the entity structure. So internal controls is going to have some flexibility to different entities. So 3 categories of objectives. We have operating objectives, activities and efficiency of a firm's operations on financial performance goals. So we want to improve the efficiency and accuracy for the performance for the financial statements. Reporting objectives, so reliability of reporting, including internal and external financial and non-financial reporting. So when we do provide our reports, we do want them to reflect accurately the financial information. Compliance objectives, adherence to applicable laws. So of course the internal control should also help us to make sure that we are in compliance with laws. Okay, so 5 components of internal controls. We'll talk more about these individually. We have the control environment, the risk assessment, control activities, information and communication, and monitoring. Let's take a look at these individually. Control environment sets the tone of the firm and influences control consciousness of its employees and establishes the foundation for the internal control system. So that's going to be basically the kind of the culture of the firm, usually set from the top down, and it includes management's philosophy and operating style, integrity and ethical values of employees, organizational structure, the role of audit committee, proper board oversight for the development and performance of internal control and personal policies and practices. Risk assessments, a dynamic process for identifying and analyzing a firm's risk from external and internal environments. So we're always going to try to balance the risk that is out there with the internal controls that we need to implement in order to mitigate that risk. Different firms, different industries will have different risk assessments and levels in different areas. Allows a firm to understand the extent to which potential events might affect corporate activities, and risks are analyzed after considering the likelihood of occurrence and the potential loss. Those are being the risk analysis. The analysis serves as a basis for determining high risk should be managed. Based on that analysis, we're going to figure out what we need to do in terms of the internal control in order to manage control activities. A firm must establish control policies, procedures, and practices that ensure the firm's objectives are achieved and risk mitigation strategies are carried out. So these, of course, will be the activities that will then be implemented, occur throughout a firm at all levels and in all functions. Information and communication supports all other control components by communicating effectively to ensure information flows down, across, and up the firm, as well as interact with internal parties such as customers, suppliers, regulators, shareholders, and inform them about the related policy positions. So once we put in the procedures and policies, it's a whole nother challenge to make sure that everybody is informed, aware of the policies, and can fulfill them as needed. Monitoring activities. The design and effectiveness of internal controls should be monitored by management and other parties outside the process in an ongoing basis. So management should constantly be reviewing the internal control process. It's not good enough just to make the process. We got to make sure that it was implemented, communicated, and is now being followed. And findings should be evaluated, and deficiencies must be communicated in a timely manner. We have to correct the errors if these internal controls are not being implemented and followed. Necessary modifications should be made to improve the business process and the internal control system. So, of course, changes will be made based on the monitoring of the activities.